Okay, let's dive in. Financial sectors can feel pretty complex, especially when you weave in social impact. We're talking about a part of the financial world that maybe doesn't always grab headlines, but it's absolutely critical for millions of people.
Exactly. And today we're looking specifically at India's microfinance sector. This really isn't just about loans and numbers. It's fundamentally about financial inclusion. It's about empowering communities that are often, left behind by traditional banking.
Right. And our mission today really is to unpack why this sector, which has faced some, frankly, huge challenges, is now being talked about as undergoing a resilient reset.
Mm.
We want to look at the hurdles, the strategies from both the industry itself and regulators, and what it all points to for the future, which looks pretty robust.
Yeah, it does. And we're basing this on some solid analysis. We've got the Aventis report. It's actually titled The Resilient Reset of India's Microfinance Sector. So very direct. And also a broader microfinance sector report that gives us more context on the growth, the rules, and that resilience factor. So hopefully you'll get a really clear picture of what's happening in this dynamic area.
Okay, so resilience. You mentioned it. The report titles mention it. Why is that the word that keeps coming up? It sounds like this sector's defining trait.
It really is. I mean, think about it. This isn't a sector that's had, smooth sailing. Far from it. Over the last 20 years, it's been hit by multiple really significant shocks.
Right, like what specifically? Can you give us some examples?
Sure. You had the Andhra Pradesh ordinance and a big farm loan waiver back in 2010.
Mhm.
That was huge.
Yeah.
Then demonetization, which shook everything up.
Oh, yeah, I remember that.
Then more farm loan waivers, floods, other natural disasters.
Yeah.
Then the whole MBFC crisis.
Which hit the broader financial system, too.
Exactly. And then, of course, a global pandemic, COVID-19. Any one of those could have been, potentially catastrophic.
But it wasn't. The sector kept adapting.
It kept adapting. It pushed through. And what's really interesting and maybe counterintuitive
Yeah.
is that the pattern we see is that the downturns, the recovery periods, they're actually getting shorter over time.
Huh. Shorter down cycles.
So their down cycles and the up cycles, the growth periods, seem to be getting longer. It's like the sector learns, gets more efficient at recovering with each crisis.
That's fascinating. So it builds immunity, almost. And the growth before this recent reset phase, it was pretty dramatic, wasn't
Oh,
it?
absolutely explosive. Let's put some numbers on it. The gross loan portfolio, that's GLP, the total loans outstanding, it went from about 60 billion rupees back in FY08
Okay, 60 billion?
to over 3,800 billion rupees in FY25.
3,800 billion. That's, what, a 60-fold increase?
More than 60 times.
Yeah.
In less than 2 decades. And you had periods in there like FY14 to FY19 where the compound annual growth rate, the CAGR, was a staggering 46%.
46% CAGR. Incredible. And disbursements, the actual money going out.
Similar story. From 95 billion in FY08 to over 3,800 billion in FY25. That's a 19% CAGR just from FY21 to FY24, even through recent turbulence.
Okay, but growth like that?
Yes.
Sometimes it comes with volatility.
It's
Right.
very
What about the financial health, like returns?
Yeah, you definitely see swings. Return on equity, ROE, it's been all over the place historically. Maybe around 8%, jumps up to 20%, then dips down to like 3.6%, then back up near 20%. Right now it's lower, about 1.8%, reflecting these recent pressures.
And credit costs, the cost of loans going bad.
Those varied too, from lows of maybe 0.5% up to around 1%, then spikes to 3.9%, down to 2.8%. Currently, it's higher again at 6.2%, which reflects that asset quality stress we'll talk about.
So periods of high returns, but also periods of real stress. It paints a picture of dynamism, but also risk.
Exactly. Volatile, yes, but underneath it, a consistent ability to bounce back and deliver strong performance over the cycle.
So if it's so resilient, why the need for this reset now? What went wrong recently?
The core problem really was over-leveraging. Too much debt piling up on individual borrowers.
How did that happen?
Well, think about it. You have rapid credit growth, lots of lenders may be pushing loans, especially in markets that were already quite saturated. And this growth started to outpace the borrower's actual capacity to repay all those loans comfortably.
Right, so multiple loans from different places, maybe without full visibility between lenders.
Precisely, and that inevitably leads to rising delinquencies, people falling behind on payments, and the overall asset quality, the health of the loan books, starts to deteriorate.
And this wasn't happening evenly across the country, was it? Some areas were more affected.
Definitely. Our sources really pinpoint specific states. Bihar, for example, represented 16% of all outstanding microloans by March 2025. That's huge. Uttar Pradesh had 11%, West Bengal 10%. There was a clear geographic concentration.
Why those states in particular? Was it just higher demand or something else?
It's usually a mix of factors. High demand, maybe existing high penetration levels, sometimes specific local economic issues play a role. But the key problem identified was multiple lenders all targeting the same borrowers in these specific regions.
Got it. And that led to borrowers having loans from many different
Yeah,
institutions.
exactly. In those stressed states, Bihar, UP, Odisha, Madhya Pradesh, you saw a big jump in borrowers who had loans from 4 or more different MFIs. Take Bihar again. March 2022, it was about 4.2% of borrowers with 4-plus lenders. By March 2024, that had more than doubled to 8.7%.
Okay, so individual borrowers getting stretched really thin.
Exactly. And that directly translated into spikes in delinquencies. We look at PR 60-plus portfolio at risk over 60 days past due and PR 90-plus over 90 days. Those numbers went up significantly in those areas.
And PR 90 plus, that's the serious delinquency measure, right?
Right.
Where did that peak overall?
Overall, for the sector, PR 90-plus hit 2.1% in September 2024.
2.1%. That sounds like a clear warning signal.
It absolutely was. It showed that things were getting stretched and a correction, a reset, was definitely needed.
Okay, so the problem was clear. What was the response? This resilient reset in action.
Well, it's really interesting is how it came from two directions almost simultaneously. You had the industry itself taking proactive steps, and then supportive regulatory actions kicked in as well.
Let's start with the industry. What did they do?
So the Microfinance Institutions Network, MFIN, which is the industry body, they stepped up pretty decisively. They introduced what they called MFIN guardrails. This was basically self-regulation, putting stricter norms in place across the industry to tackle that over-leveraging and fix the asset quality issues.
Self-regulation first. That's quite mature, isn't it? Often regulation leads.
It is. It shows a level of foresight. So Guardrail 1.0 came in July 2024.
Okay, what did that involve?
Some clear, hard limits. First, maximum of 4 MFI lenders per borrower. No more stacking loans endlessly. Second, a cap on total microfinance debt for any single borrower. 0.2 million rupees, or 2 lakh. And third, crucially, no new loans to customers who are already delinquent, specifically 90 days or more overdue with an exposure over 3,000 rupees.
Okay, so hitting the brakes on lending to already stressed borrowers and limiting overall exposure. What was the impact?
The immediate effect was a shift in focus. Lenders started looking more towards new-to-credit customers, people who hadn't borrowed before, and exploring opportunities in less saturated, untapped markets, which is, fundamentally a healthier way to grow.
And that was just Guardrail 1.0? There was a 2.0?
Yes, they tightened things further in November 2024 with Guardrail 2.0. This really showed they were serious. They dropped the max lenders per borrower from 4 down to 3.
Wow, okay. Even stricter.
Yeah. And they expanded that 0.2 million rupee debt cap. Now, it included not just microfinance loans, but also other unsecured retail loans, closing a potential loophole there. They also lowered the delinquency bar for getting new loans. Now, if you were overdue 60 days or more with 3K plus exposure, you couldn't get more MFI funding.
60 days, not 90. Okay.
And they set a target for seeding PAN numbers. That's the permanent account number, like a tax ID for 50% of borrower accounts. Better tracking, better data. Plus, they mandated that boards of the MFI companies needed to monitor interest rates more closely.
So these guardrails sound pretty comprehensive. What effect did they have on the ground?
Well, the big picture effect was definitely an improvement in asset quality, because borrowers just had more capacity to repay when they weren't juggling so many loans. And it also pushed MFIs to think more about secured lending, like microloan against property or micro-LAP.
Right, loans backed by some collateral. But it wasn't just MFIN setting rules, was it? Individual MFIs were changing how they operated, too.
Absolutely. That's the other key part of this internal adjustment. MFIs started redesigning their own processes. Things like tightening up their underwriting discipline, being more selective about who they lend to, especially new borrowers.
Making the credit checks tougher?
Tougher criteria, yes. Maybe rationing disbursements in branches that were showing signs of stress. Encouraging better attendance at group meetings, which are crucial for repayment discipline in the JLG model. And beefing up their internal audit teams.
Okay, so more caution on the lending side. What about pricing?
This is really interesting. They started moving towards more calibrated risk-based pricing. But not just at the state level, which was common before. Now they're doing it at a granular district level.
District-level risk pricing? That sounds quite sophisticated for microfinance.
It is. It means they can adjust interest rates based on the specific historical delinquency rates and economic conditions of a very local area. Much more tailored, much more sustainable. They also rationalize lending rates generally.
And diversifying products, too. You mentioned micro-LAP.
Yes, increasing the share of secured products like micro-LAP or even gold loans, reducing reliance purely on unsecured group loans,
Mm-hmm.
and also offering sort of opportunistic top-up loans, but only to customers with a really good, proven repayment track record, rewarding good behavior.
Makes sense. And geographically, pulling back from problem area.
Rationalizing expansion, yes.
Hmm.
Slowing down growth in districts with high delinquencies, and actively shifting focus to genuinely underserved areas where the need is high but penetration is low.
And finally, collections, getting the money back.
Big focus there. More rigor. That means increasing the number of field staff actually going out to meet borrowers, adding incentives specifically for successful collections, providing more targeted support from central offices to branches needing help. In some cases, shifting from monthly to weekly collection models for tighter monitoring, and investing more in training those collection teams.
It sounds like a really thorough overhaul internally.
It really is a multi-pronged approach to build resilience from the inside out.
Okay, so the industry is cleaning house. What about the regulators? Were the government and the RBI just watching, or did they step in?
They definitely stepped in, and quite supportively, we saw some helpful regulatory tailwinds. A prime example is the revamped Credit Guarantee Fund for Microunits scheme, the CGFMU. That was updated in October 2024.
CGFMU, what did the update do?
Several key things. It doubled the maximum loan limit covered by the guarantee, from 1 million rupees up to 2 million. It expanded the scheme to cover loans to self-help groups, SHGs, specifically for amounts between 1 and 2 million rupees. That brings a huge segment under the umbrella.
So bigger loans and SHGs now included. What about the guarantee itself?
That got much stronger. Previously, it covered 50% of the lender's loss, but only on losses exceeding 5% of their portfolio. Now it covers 75% of the loss, kicking in once losses exceed just 3% of the portfolio, though it's capped at 15% of the total insured amount.
So lower threshold, higher coverage. That significantly reduces the risk for lenders, right?
Massively, especially in bad years. Our sources did some back testing, and it suggests this scheme could significantly lower credit costs and reduce earnings volatility for lenders who use it. The break-even point is around a 2.8% default rate, which seems pretty achievable.
So a real incentive for lenders to participate, are they?
Yes, reports indicate many lenders have already adopted the revamped scheme. It makes financial sense. The fee structure was also tweaked, especially to be more favorable for SHG loans. And eligibility was broadened slightly to include joint liability group enterprises, not just individuals.
Okay, so that's a major government support mechanism strengthened. Anything else from the regulators, like the RBI?
Yes, relatively recently, within the last few months mentioned in the reports, the Reserve Bank of India tweaked the rules for NBFC MFIs. They revised the qualifying assets criteria. Basically, these institutions previously had to ensure 75% of their assets were microfinance loans. RBI lowered that threshold to 60%.
60%. What does that mean practically?
It gives these NBFC MFI a bit more flexibility in their operations, maybe allows them to diversify their loan book a little more easily without losing their MFI status. More operational breathing room.
Okay, so you've got industry guardrails, internal MFI changes, and supportive regulatory moves. That's quite a combination. Are we actually seeing the results yet? Are there green shoots?
Yes, absolutely. The reports suggest early signs of stabilization and recovery are now quite visible.
Like what? What are the indicators?
Well, remember that issue of borrowers having too many lenders? We're seeing consolidation there. Portfolio exposure where borrowers have 3 or more lenders has dropped significantly. It was 20% in March 2024, down to 12% by March 2025. That shows those MFIN guardrails are biting.
20% down to 12%. That's a big shift in just a year. Fewer lenders per borrower. What about the total debt load per borrower?
That's also improving. The percentage of borrowers with that high exposure, 0.2 million rupees or more, fell from 8% in March 2024 down to just 3% in March 2025.
8% to 3%. So the borrower base is definitely less leveraged, less stressed.
It's exactly healthier borrower profiles. And collection efficiencies, the CE rate, that's trending upwards nicely too. It climbed from 95.2% in Q2 of fiscal year 2025 up to 97.8% by Q4. That's a really strong indicator of improving repayment discipline and operational effectiveness.
Nearly 98% collection efficiency. That sounds very healthy. Now, you mentioned write-offs earlier, and they spiked.
Yes, and that's actually another positive sign in this context. MFIs took accelerated write-offs in the last couple of quarters covered. Write-offs as a percentage of their assets under management, AUM, jumped from just 0.1% in Q4 FY24 to 4.8% in Q4 FY25.
That sounds bad initially, writing off nearly 5% of assets.
It sounds bad, but it's actually proactive cleaning. They're recognizing and removing the older stressed loans from their books more aggressively. It cleans up the balance sheet, makes the remaining portfolio healthier, and provides a more transparent base to move forward from. It's a necessary step in the reset.
Okay, clearing the decks. And the bottom line, that PIR 90-plus number, the key delinquency metric.
That's heading in the right direction, too. It peaked at that worrying 2.1% in September 2024, remember. By March 2025, it had decreased to 1.4%.
1.4%. Still some stress, but a definite improvement from the peak.
A clear downward trend.
Hmm.
So yes, multiple indicators, these green shoots, they all point towards stabilization and the beginning of a recovery.
So putting it all together, after this quite intense period of challenge and reset, what does the future look like? What's the outlook?
The outlook is actually very compelling, quite positive. The analysis suggests strong growth ahead.
How strong?
We're talking about gross loan portfolio, the GLP, growing at potentially 15% plus compound annual growth rate. That's projected to take the sector to around 10 trillion Indian rupees in total loan size over the next 5 to 6 years.
10 trillion rupees. That's massive. And what about profitability, that ROE figure?
The expectation is that the sector will return to its historical sort of cross-cycle average ROE of around 20% within that same 5 to 6 year time frame. So not just growth, but healthy, sustainable returns are anticipated.
Yeah. Okay, 15% plus growth, 20% ROE target. What are the key things driving that optimism?
Several factors identified in the sources. Continued geographic diversification, moving into those less served areas we talked about, deeper rural penetration, really reaching more communities, a focus on engaging new-to-credit customers, bringing more people into the formal financial fold for the first time.
All right, expanding the base.
Exactly. And then there's the whole digital adoption piece. While our sources don't detail specific innovations, accelerated digital adoption is seen as a major underlying driver, making operations more efficient, reaching clients more easily, potentially new ways of assessing risk. It's a powerful force.
So why does all this matter to, our listeners? What's the takeaway?
Well, I think the key takeaway is that India's microfinance sector is demonstrating remarkable resilience. It's coming out of a really tough patch, not weakened, but actually stronger, more disciplined. You've got these proactive steps from the industry itself, combined with genuinely supportive regulation, and it's creating a much more stable, predictable environment to operate in.
And its core mission continues.
Absolutely. It continues to play this absolutely vital role in driving financial inclusion, empowering millions of underserved people across India. It's a powerful force for social good, yes, but also just for broad-based economic development. It's an engine that's resetting and revving up again.
It really is an incredible story. We've seen how this sector, this engine of financial inclusion, hasn't just, survived the storms, but has actually used them to reset itself, becoming more resilient. That mix of the industry regulating itself, tweaking operations, and getting that government and RBI backing, it really seems to be working.
Yeah. The pieces are falling into place for the next phase. And as it heads towards that predicted 10 trillion rupee GLP, with digital playing a bigger role, it does make you think, doesn't it? It raises a question maybe for you to ponder. Talk about accelerated digital adoption, but what could truly transformative tech innovation look like in this space? Beyond just making current processes faster or cheaper, how could technology fundamentally reshape lending and repayment, especially with something like the joint liability group model, which is so based on community trust? What new efficiencies could emerge, or maybe what new challenges might we see as tech gets woven even deeper into the fabric of finance for India's vast rural and underserved populations? How does it change that human element?